Welcome to Wealth Center's training courses. Wealth Center is a registered company in Abu Dhabi, United Arab Emirates. Wealth Center is established with a vision to educate Arab investors on trading the global financial markets. This is the first lesson in the Advanced Forex Trading course. This lesson will introduce you to Forex trend analysis. Trending markets can be intimidating for novice traders, so understanding the trends is essential. In this lesson, you will learn about various types of trends and their classification. You will also learn to trade the trends as well as plan your entry and exit levels. Introduction to trends. In the Forex market, trends reflect the average rate of change in price over time. A trend is a useful indicator of where the market is headed and offers an opportunity to take action to achieve a specific target. Not surprisingly, traders consider trends to be their friend, and Wall Street believes in never going against the trend. Trend identification is the most basic function of technical analysis. A trend offers the opportunity to trade in its direction, which enables a trader to capture a large movement. Generally, a trade in the direction of the trend is considered safer. Therefore, the first step in trend analysis is to identify its direction. The simplest way to identify a trend direction is by looking at the chart. An uptrend will typically have higher highs, while a downtrend will have lower lows. Remember that the price moves in a zigzag format. That is why even in a trending market, you will also see small corrections. These small corrections provide the opportunity to place your trades at a better price. Types of trends. Trends alert us to the overall direction in which prices are moving. The prices can move up, down, or stay flat. If there isn't a current trend, prices will remain relatively the same, without price changes, and you may not be able to trade profitably. Currency trends can be categorized into three types: uptrend, downtrend, sideways trend. Trends can also be divided according to their duration: long-term, short-term, and intermediate. Uptrend. An uptrend signifies that the market is trending in the upward direction, creating a bullish market. A price rally is observed, with some periods of consolidation or movements against the prevailing trend. An uptrend is characterized by a positive rate of price change over time. The price movements on the price graph form a series of higher peaks and valleys. The trends continue until there are some changes in the conditions or value. If the general trend of the market is headed upwards, you need to be cautious about taking any positions that rely on the trend moving in the opposite direction. The EUR-USD chart is a classical example of an uptrend. The pair is continuously making higher highs, which not only indicates the trend direction, but also highlights its momentum. Downtrend. A downtrend in the Forex market is characterized by a price decline, with some periods of consolidation or movements against the prevailing trend. Contrary to an uptrend, a downtrend results in a negative rate of price change over time and signals the continuation of a downward move. The price movements indicating a downtrend form a series of lower peaks and valleys in the price graph. The Forex market is not affected as much by downturns as other financial markets. As selling is such a common phenomenon in this market, it is fairly immune to downward trends in price. You trade one currency against another, which means something is always going up, even in times of financial or economic turmoil. On this chart, you can see that USD CAD is in the downtrend. The continuous lower lows are indicating the momentum of the trend. Sideways trend. A sideways trend is a horizontal price movement between levels of support and resistance. It occurs when the market does not have a sense of direction and ends up consolidating most of the time. A sideways trend is seen as horizontal lines occurring between drops and falls in currency price. The trend can last anywhere from a couple of days to a few weeks, after which the price can rise or drop off. The direction in which a currency price moves after a sideways trend in the market is most often the original direction prevalent before the trend occurred. Currency prices can be said to behave more stably during a sideways trend. This offers an entry point for investors with targeted trading strategies. However, the common trader behavior during a sideways trend is to lay low until a new trend emerges. On this chart, the USD CAD is trending sideways. The price in a sideways channel generally remains contained. The sideways trends are often followed by a large upwards or downwards movement. Trend classifications. The trends are mainly classified as major, intermediate, and minor trends. A major trend is made of several small trends. A minor trend is a trend that occurs within a larger. It also helps to form the shape of a large trend. An intermediate trend is basically a consolidation phase that signals the making of a larger trend. A longer intermediate trend is generally followed by an even longer major trend. Similarly, an intermediate trend can also form towards the end of a major, which can be taken as the signal of a trend reversal. On this EUR-USD chart, you can see an intermediate trend that is followed by a major uptrend. You can also see the minor trend within the major uptrend. Using trend lines to spot the trend. A trend line is one of the most common ways of spotting a trend. Traders visually spot the price movement on a chart and then connect various points using a trend line. The price of a financial instrument does not move in a straight line. The price will either move higher, lower, or simply in the sideways direction. In an uptrend, the price makes higher highs, and in a downtrend, the price makes lower lows. By connecting these higher highs and lower lows, trend lines help traders to establish a trend. In an uptrending market, the trend is generally identified by connecting the support areas which draw an angled trend line. Similarly, in a downtrend, the trend is identified by connecting the resistance area, which also draws an angled trend line. The trend lines then are seen as the support or resistance areas, and a breach above or below these areas mark the reversal of the trend. In this example, the GBP USD uptrend is established by drawing an angled trend line that is connecting to most of the support areas. The trend is likely to continue as long as it remains above the trend line. A breach below the support line will likely mark the end of the downtrend. In this example, the USD JPY downtrend is established by using an angled trend line that is connecting several resistance areas. Once again, the downtrend is likely to continue as long as the price action remains below the trend line. A breach above the resistance line is likely to mark the end of the downtrend. Thrust and reaction. A bigger move in the financial market is generally followed by a reaction. If you look at the charts carefully, you will realize that after nearly every big move, there is a correction. The bigger move is called the thrust, and the correction refers to the reaction. Why does it happen? Is primarily because of the profit booking. For example, when the market is in a strong uptrend, more and more investors start to buy, and that takes the price further higher. But after a significant upwards move, the investors start closing their positions to book the profit, which once again brings the price lower. Planning your entries and exits. There are several ways to plan your entries and exits. One of the simplest ways is to follow the trend. For example, if you spot a bullish trend, your primary focus should be to make a buy trade. Now, to plan your entry, one way is to draw a trend line by connecting the support areas of the trend. When the price drops to the trend line support area, you can enter your buy trades. The stop loss for buy trade is generally kept below the trend line support area, and the take profit is kept at or slightly below the previous high. Depending on the price action, you can extend your take profit, but it largely depends on how the uptrend is reacting. Similarly, to trade the downtrends, you can draw a trend line to connect the upper resistance areas. Now you can enter a short position when the price slightly recovers and touches the resistance lines. The stop loss for the short trades is generally kept above the trend line resistance area. The take profit typically remains above the previous low. Once again, the take profits can be extended based on the strength of the trend. Trend following. Trend traders create strategies that are developed based on analyzing the trends of an asset. A trend-following strategy is based on the expectation that the direction of the price will continue in its current form and the trend will not reverse. This means that if you are trading an uptrend, you can continue to hold your long position and watch the asset increase in value, while you can choose to sell your asset if the trend is going downward. Trend following guideline. One way to follow an uptrend is to hold a long position until you get an indication of a possible change in the trend. The other way to follow the uptrend is to continue taking long positions on pullbacks and close them on small gains. Just like in the uptrending markets, one way to trade the downtrend is by taking short positions on rallies and exit on small profits. The other way to follow the downtrend is by taking a short position on a small rally and hold it for a bigger profit until you get an indication of a possible change in the trend. Short-term trend trading. Short-term traders, such as day traders, like to keep their eye on trends that arise throughout the day in short periods to try and benefit from short-term price fluctuations. There are a variety of popular short-term strategies, such as scalping and day trading. A scalping strategy is usually based on a 1 to 30-minute interval. An ideal way to scalp the market is to usually spot a trend and place the trades in the direction of a trade. For example, if the market is trending higher, a scalper prefers placing the long trades. Similar, if the market is heading lower, the scalper preference would be to place short entries just to stay on the side of the trend. Intraday trend trading. Intraday trend traders would usually hold positions until the end of each day. Therefore, day traders can analyze trends that are only active for a short period within the day, even for a few minutes or hours. Intraday trend following consists of analyzing the shorter-term fluctuations and movements in price. For example, if there is an uptrend during the day that consists of a series of movements creating higher relative highs and lows, then traders could place a trailing stop before the low and then at the next higher low in the trend in case the trend were to suddenly reverse. When following a downtrend, intraday trend following could be beneficial, as this involves a short selling strategy, which is often used by short-term traders. Long-term trend trading. Long-term trend trading involves holding onto a position for longer periods, often that is in an uptrend. This could be a few weeks, months, or even years. Long-term traders make decisions based on an in-depth fundamental analysis that predominantly focuses on how the market will look in the future. When it comes to trend analysis, long-term traders are less concerned with the daily trend fluctuations and concentrate more on the longer-term trend and its influential factors.